Look at this question first. I think if you do this question, we will understand the provision really well. And then we will do the other two questions or other 3, 4 questions in this area. Look at the call of the question. Based on the following facts, what is the maximum amount of casualty loss that the taxpayer can deduct on year 1 tax return, which is due on April 15, year 2? On March 28, year 1, the taxpayer sustained a loss to her personal property due to an earthquake. The property was in an area that was declared by the President of the United States to be eligible for federal disaster assistance. So I know that this is an eligible loss. The fair market value before the earthquake was $23,000, but after the earthquake fell to $6,300. So how much is the decrease in fair market value of the property? How much is the decrease in fair market value of the property? So I will calculate what was the fair market value before the loss, what was the fair market value after the loss. So this becomes $16,700. How much loss is allowed? It's either the fair market value of the property or the cost basis is lower. So I'll take the loss as $16,000. So it's either $16,000 or $30,000, whichever is lower. Now from here, did I recover any other figure from either insurance or from somebody else? Here, yes, I got some relief funds to replace the property which was lost. So what was the relief fund? So this is the amount that I received, which is $2,300. So now I know that my net loss was actually $14,400. Now don't forget the $100 here, guys. There is only one property here. I will get $14,300. This amount in excess of 10% of AGI, which is $27,000, will be allowed as a deduction, which is $2,700. So the amount of loss, from here I'll reduce 100, from here I'll reduce 2,700, it becomes $11,600. It's a very good question that establishes the provision really well. First condition, it has to be a loss arising from federal declared disaster. Second, figure out what is more. What is lesser. The lesser of the two, which is either the decline in the fair market value of the property or the adjusted basis, whichever is lower. Of course, you cannot take a deduction which exceeds the figure that is there in your books. And from there, you reduce any recoveries that you had either from insurance or from the government. And then whatever is the balance loss, you reduce $100 per loss. And then you add up all of these losses, any amount which is in excess of 10% of the AGI, only that excess amount will be allowed as a deduction. So now see, this makes so much of sense, right? In my example, I took a smaller loss, which is what? Fair market value before the loss, which was some... and decreased fair market value, I think, was some $14,400. How much was it? I don't remember now. Yeah. So this was $16,700. Do you realize what we did? We took $16,700, and then from there, I reduced the insurance recoveries, and then I reduced $100. I got the eligible loss, and I added all. In my case, there was only one loss. And from there, I reduced 2,700, which was excess of 10% of AGI. So remember, only the excess over 10% of AGI is allowed as a deduction. Just like medical expenses, it is not till 10%. It is only the figure which exceeds 10% of AGI that is allowed as a deduction. Now look at this question. Now we are having more than one property. First, remember, when you look at the question, don't forget the bigger picture. Don't forget that it has to be only non-business property. Second, it has to be from a property in an area which is declared as a federally declared disaster area. Third, it has to be either the decrease in fair market value or the cost basis, whichever is lower, reduced by recoveries, reduced by $100 per item. And then in an aggregate, you're going to take it at a figure which is in excess of 10% of AGI. The question, what is the amount of casualty loss that Mr. and Mrs. Smith can claim on their joint return for the current year? Mr. and Mrs. Smith had water damage in their home during the current year, which ruined the furniture in their basement. This was in federal disaster area. The following items were completely destroyed and not salvageable. You have a bed frame, you have pool table, you have flat screen TV. Their homeowner's insurance policy had $10,000 deductible for the personal property, which was deducted from the insurance reimbursement of $12,700. Their AGI for the current year was $30,000. So any amount in excess of 10%, which is 3,000, only will be allowed as a deduction. First of all, am I going to treat each of these as separate items, and for each of them am I going to reduce $100? What do you say? For each of them am I going to reduce $100? What do you say? They are all furniture. This is just one item. They're all furniture, okay? So what is so it's either so these are completely destroyed, right? So basically fair market value before minus 0. So it's actually whatever is a fair market value limited to cost basis. That would be allowed as a deduction. So in case of, one second. So in case of antique bed, I lost 5,000 in market, but the value in my books were restricted to 4,000. So I'll take 4,000 here. So it's either 5 or 4, whichever is lower. For pool table, I had it in my books at 10, but I lost 8. So I'm going to restrict it to 8. Same for the large screen TV. I'm going to restrict it to $700. So the total amount was 12,700. But I could not get this extra 2,700. I could get only 10,000 out of that. Is this clear, everybody? So out of this, I could not deduct 2,700. I could only, this is not deductible. Okay, so I start with 10,000. I reduce 100. I get 9,900. In excess of 10% of AGI, that means $6,900. I get 6,900. Unmute yourself. Naveen, what is your question?
Why this 2,700 is not deductible?
Because you've told that you're going to get the amount maximum which is deductible is 10,000.
Okay.
Have you understood?
Yes.
This is a provision that I just wanted to explain to you. What choice does she have regarding when she can claim that loss on her tax return? Now, this is a provision. In year 3, in the third year, the US president declared a federal disaster due to flooding in a particular area. The taxpayer lives in that area and lost her home in the flood. Now, she has a choice of either claiming it in the current year, or if she wants, she can go back and she can claim it for the last year itself. That means year before. So this is a provision that I wanted to explain. You can either claim these losses in year 2 or in year 3. So this is the current year, or you could go back and claim it for the second year also. Okay? Because we want to really help you. If you would have filed some return last year and if you would have paid taxes last year, this year you could file a revised return for last year and you could claim. So there is this concept of carry back, which is permissible in the US, and you can file a refund claim, because right now I want to give you as much assistance as I could be giving you. So it's either in the year of disaster or the year there, or a year before that. Okay, they've already done this question. That's it. It's a very simple provision. We are going to do this provision again when we are going to do part 2, because there you will see that in corporate, when you're talking about business deduction in C Corps, you will see that there's a small twist in this situation. Okay, we'll talk about it. But just remember that when you go to C Corp and when you do the casualty loss deduction, there is a difference between how you calculate it for individuals and how you would be calculating it for the registered C Corps.